Talk about the emotions of riding up and then what contradictions and what creates a dissipation of a bubble.
One of the central ideas I develop in the book is the idea that people have emotional relationships with financial assets. It's a bit that when we talk about stories, what a story really is your imagination about what's going to happen to you and that asset. And the key thing is what state of mind people are in when they're making these decisions. Because in reality, any decision you make has upsides and downsides, and this is what good fund management can do with really good, statistical backup and so on. They can try and think about, well, what can go wrong, what can go right, and they can try and put a numbers on it. There's nothing wrong with doing that. What's the problem is if you actually believe those numbers rather than see that what they are is helping you to make a human judgment. Now, human beings make judgments in states of mind. One state of mind, which I called integrated, is one where you can think about things that make you uncomfortable as well as things that make you feel comfortable and nice. A realistically orientated person can think of both and then will have to make a decision, but knows there are two sides. They won't get. Someone who can't stand the feeling of thinking thoughts which are disappointing may put those thoughts to one side. We say in psychoanalysis they make them unconscious. It's not that they're not there, they're somewhere in the mind, but they're not known by the person. And so, of course, if they're not known, they're in what I call a divided state. That makes them completely free to go charging after excitement with nothing holding them back. Or in another state, it can make them totally anxious and unable to see there's any positive opportunity because they've put the positive out. So states of mind and the way relationships to these things matter are hugely influential. Now, I think what happens in a bubble is that people become extremely excited about the object, whatever it is, dot-coms or tulip bulbs or whatever, and they tend to get into these divided states, pressured by various institutional factors, such as that, if you don't get on the train, you could lose out, and so on. Plus, there's something called group feel. That is to say that groups have a habit. Groups can get together and work in two kinds of ways. One kind of way is that people can orientate themselves to reality outside the group and can discuss amongst themselves the pros and cons of what they're doing. But another kind of thing, which is very good if what you're doing is playing American football or something, is you all get together to feel good together and then you charge off together and win. That's not so good if what you're supposed to be doing is thinking. And markets, I think, get into these states of what's called herding, but I think of it as group feel. It can be called group think, but I don't want to call it group think because it's not really about thinking, it's about feeling. Groups have a tendency not to think. And of course, you can do things about the structure of the way you set them up, which can make that easier or more difficult.
I remember during the NASDAQ bubble, you couldn't get anybody on the phone because they were all trading their own account, all from the long side. All the dentists wanted to quit and become day traders, and we had a group feel that writ large in our society.
And that's what it was said at that time, and then again more recently with housing and mortgages.
Well, I always say whenever they try to privatize Social Security, that means the market's near a top because people feel safe enough to do self-managed rather than forced savings in their portfolio.
Point.